What is volume continuation strategy? This is exactly what we will explore in this lesson. A volume continuation strategy is trading approach where we trade in the direction of the trend, whether it's an uptrend or downtrend. We always want to identify and confirm the trend using a higher time frame. On lower time frame, we then enter intraday trades lasting a few minutes or several tens of minutes, always in the direction of the trend identified on the higher time frame. It's basically a type of strategy where we wait for strong delta with high volume and price acceptance. The volume and delta that price leaves behind serve as a strong entry point for our positions. As I said, this strategy works best in trending market. So if you have range consolidation on a higher time frame, using this strategy in this type of conditions is a bit risky. So trend from higher time frame is number one condition that we want to see if we want to trade this type of strategy. When we know that the market is in a certain trend, we can take advantage of the momentum and ride a wave from the area where strong activity occurred that pushed the price in the direction of the trend. So when we see trend, for example, on a 4-hour time frame, we can then switch to 5-minute time frame and start looking for some entry points. A strong entry point for this type of strategy are candles with high volume and strong delta in the direction of the trend from higher time frame. These candles must be price accepted, meaning that when we see a positive delta, we want to see price to close above it. When we see candle with high volume with negative delta, we want to see price close below it. Because when you think about it, if it were the exact opposite, it would be absorption, which means reversal. But we want to trade continuation. The moment we want to enter the market with a limit order is exactly at the candle with high volume and delta that pushed the price in the direction of the trend. The stop loss is always placed above or below, depending on the direction of the trade. Important point. The candles on which we place our limit order must always be untested, so-called naked candles. Candles that have already been tested no longer reflect the price as effectively. Naked, untested, high volume/high delta candle is not overlapped neither by the wick nor the body of the other candle from the right side. Naked candles most often appear in aggressive trends when the price rises or falls sharply. The price doesn't have the strength to test this volume at the time. However, when the price returns to them in the future, it usually reacts strongly, bouncing price in the direction of the trend in which they were formed. And this is exactly where we want to be active at, because these sharp bounces are exactly the moments that we want to capitalize on. Why does the price reverse at these points? The answer is volume and delta. If we know that in the downtrend on higher time frame there was selling interest on a 5-minute time frame with high volume and price acceptance, there is a very high probability that when we return to these levels, sellers will become active again, and this trigger a massive sell-off, starting the next short wave that we want to capitalize on. Same applies for uptrend. When we see uptrend on higher time frame and on a 5-minute time frame, we see a lot of buying interest supported by volume and price acceptance, we can expect bounce to the upside when we retrace to these levels again. So this is the basic idea and explanation behind the momentum continuation strategy. Now let's take a look at how to trade this strategy specifically in an uptrend and in a downtrend.